Lesson 24.4 Leverage Trading. Let me start with a number that ruins people. 10x. You open a trading app, you see a little slider that says leverage, and it goes up to 125 times on some exchanges. You have $1,000. You think, if I use 10 times leverage, that is like trading with 10,000. Bitcoin goes up 5%. I make 500. That sounds amazing, and then you do it. And Bitcoin goes down 3% overnight. And you wake up to find your account is gone. Not down. Gone, liquidated. The whole 1,000. That is what this lesson is about. And I want to be very direct with you here, because this is the most dangerous topic in the entire course. Leverage is the thing that takes a normal trader and puts them in a hole they can't climb out of. It can be used responsibly, and I'll show you how. But most of the people watching this should probably stay at low or no leverage for a long time. So let's actually understand what we're talking about. Not just the marketing version. What leverage actually is. Leverage just means borrowing money to take a bigger position than your own cash would allow. That is it. You put up $1,000 as collateral. The exchange lends you more. And now you are trading as if you had 2,000, or 3,000, or 10,000. The reason people do it is obvious. If you think an asset is going up, why not borrow money, buy more, and make more when it goes up? And on paper that works. The reason it is dangerous is the second half of that sentence that nobody reads. When the asset goes down, you also lose more. The multiplier does not have an opinion. It goes both ways. So if you are at 3 times leverage and the price moves 5% against you, you don't lose 5%. You lose 15. That is the entire game. You are scaling both sides of the equation by the same number. There is a separate type of account for this. On Binance and most other exchanges, you have your spot account, where you just buy and sell what you actually own. Then you have a margin account, which is where the borrowing happens. To trade with leverage, you transfer funds from spot into margin, and that money becomes your collateral. The exchange watches that collateral very closely, because they are the ones lending to you and they want to be sure they get paid back. How a position works, let me walk through a long position step by step, because the mechanics matter more than the code. Say you have $1,000 in your margin account, and you want to go 3 times long on Bitcoin. You don't need 3,000 of your own. You put up your 1,000, the exchange lends you 2,000, and now you have 3,000 to buy Bitcoin with. You buy it. Your 3,000 is now worth 3,300. You sell, you pay back the 2,000 you borrowed, and you walk away with 1,300. You made 300 on a $1,000 account, which is a 30% return even though Bitcoin only moved 10%. That is the dream. Now the same setup, and Bitcoin drops 10%. Your $3,000 position is now worth 2,700. You still owe the exchange 2,000. So your equity is 700. You've lost 300 on a 10% move. That is 30% gone from your account on what was a completely ordinary day for Bitcoin. And here is the cruel part. If it drops much more, you don't get to just wait it out. There is a line. Liquidation. And the math that ends accounts liquidation is the moment the exchange forcibly closes your position, because your collateral isn't enough to cover what you owe anymore. They don't ask. They don't warn you twice. They just close it, take what they need to repay the loan, and hand you whatever's left, which is often close to nothing. Every exchange has what they call a maintenance margin rate. On Binance for spot-style margin, it is around 10%. That means you need to keep your equity above roughly 10% of what you've borrowed, or they liquidate you. The exact number depends on the asset and the tier, but the idea is the same everywhere. Let's do the math on 3 times leverage long. You put in 1,000, you owe 2,000. You have 3,000 worth of Bitcoin. For the exchange to feel safe, your equity needs to stay above the maintenance margin on the borrowed amount, so you need at least $200 of cushion above what you owe, which means you can lose up to about $800 of value before they pull the plug. On a $3,000 position, that is roughly a 26% drop. So at 3 times leverage, a 26% move against you and you are liquidated. Now do 10 times leverage. You put in 1,000, you borrow 9,000, you have 10,000 worth of Bitcoin. The maintenance margin on 9,000 borrowed is around 900, so you can lose only about $100 before you are liquidated. On a $10,000 position, that is a 1% move, 1%. Bitcoin can move 1% in 5 minutes. People get liquidated on the way to the bathroom. This is why I keep saying the math ends accounts. It is not a theoretical risk. At higher leverage, the price barely has to twitch and you are gone. And there is a worse detail. When the market is moving fast, the exchange might not be able to close your position exactly at the liquidation price. They close it at whatever the market will give them, which in a crash can be well below your calculated line. In extreme moves, you can lose more than your initial capital in futures markets. Spot-style margin usually stops at losing your collateral, but in futures with very high leverage in a flash crash, people have ended up owing the exchange money. I am not trying to scare you for no reason. I am telling you what actually happens. Shorting with leverage, everything I just described works in reverse too. With a short, you borrow the asset itself, sell it immediately for cash, and hope the price falls so you can buy it back cheaper, return it, and keep the difference. Mechanically, you want to short Bitcoin at $30,000. You borrow Bitcoin from the exchange. You sell it. You now have USDT. If Bitcoin drops to 27,000, you buy it back cheaper, return the borrowed amount, and pocket the difference. If Bitcoin goes up instead, your loss grows the same way it did on a long, and you can be liquidated just the same. Shorting feels safer to beginners because the market can only go down so far. It can't go below zero. The market can go up indefinitely, which means the upside risk on a short is theoretically unlimited. And the markets where shorts look attractive, falling markets, are exactly the markets where prices snap back violently. A coin drops 20% in an hour. You load up a short. It pumps 30% in the next hour on a single news headline. And you are gone before the headline finishes loading. I have watched this happen more times than I can count. The cost of borrowing, people forget this part. The loan isn't free. You pay interest on what you borrow, and it accrues every hour you hold the position. The rates vary by coin and by exchange. For something stable like USDT on Binance, daily rates are often in the range of a couple hundredths of a percent, which annualizes to somewhere around 7 to 10%. For other coins, it is higher. Doesn't sound like much, but it adds up fast, and it adds up while you are sleeping, while you are at work, and especially while your position is underwater and you are telling yourself, it'll come back. Here is where it bites people. You open a leveraged position, it goes against you, you decide to hold because you are sure it'll recover. Days pass, the interest keeps stacking. Now the price needs to move further in your favor, just for you to break even, because you have to pay off the interest too. And the longer you wait, the further it needs to move. This is how a small mistake turns into a big one. The borrow cost is a slow bleed that turns into a serious wound if you let a losing position run. The rule that follows from this is simple. Leveraged positions should be short-lived. They're for trades where you have a clear thesis and a clear exit. They are not for holding for weeks hoping things work out. How to think about position size and risk. There is a classic bit of math called the Kelly criterion that tries to tell you what fraction of your bankroll to bet based on your win rate and your average win and loss sizes. I am not going to walk through the formula in detail because the implementation matters less than the lesson it teaches. The lesson is, the size of your bet should be a function of your edge. And if your edge is small or uncertain, your bet should be small. Full Kelly is famously aggressive, and most serious traders use a fraction of it, like half Kelly. Specifically because the math assumes you know your true win rate, and you don't. What this means in practice for leverage is that the right leverage number depends on your strategy's actual performance. If your backtest shows a strong, consistent edge with modest drawdowns, you can justify a small amount of leverage. If your backtest is shaky, or your win rate is barely above 50%, or you have big variance, you have no business using leverage at all. The leverage multiplies whatever you are. If you are barely profitable, leverage makes you barely bankrupt. A more practical approach for most people is dynamic adjustment. When volatility is high, you dial leverage down. When your account has taken losses, you dial it down further because you have less room to absorb another hit. When things are calm and you are ahead, you can nudge it up a little. The base case should always be low. 2 times is plenty for almost anyone. 3 is the upper edge of sane for an experienced trader. Anything above 5 times, in my opinion, is just gambling with extra steps. The honest mistakes I want to talk about, the mistakes I see over and over because they're predictable and they're worth naming. The first is reaching for high leverage because the position seems small. You only have $100. You don't want to risk it for a $2 gain. so you slap 50 times leverage on it so the numbers feel meaningful. This is the exact wrong reason to use leverage. The leverage doesn't change the trade, it changes the consequences of being wrong. The second is adding to a losing leveraged position. The price drops. You are down on paper. You think it is a great entry now. You borrow more and you add. This is called martingale, and it is the fastest way I know to lose everything. You are doubling down on a position the market is already telling you was wrong. The third is not calculating the liquidation price before you enter. People open a position and have no idea how far the price can move before they get stopped out. You should always know that number, to the cent, before you click buy. And you should set your own stop loss above the liquidation price. So you exit on your own terms, not the exchanges. I've already covered it, but it deserves a repeat. The borrow cost is real and it changes the break-even. If you don't know what you are paying, per Dalton Yai, you don't know your trade. The fifth, and the one that catches even smart people, is treating leverage as a way to make a weak strategy profitable. It isn't. Leverage amplifies a strategy's character. A strategy with positive expected value becomes more profitable. A strategy with negative expected value becomes a faster way to go broke. If your strategy doesn't work without leverage, leverage won't fix it. It will just kill you quicker. When leverage makes sense, so is there a good use case? Yes, a few. Leverage makes sense when you have a strategy with a real, tested edge, modest position sizing, and tight risk controls, and you want to scale your returns without tying up all your capital in one trade. 2 or 3 times leverage on a strategy that wins more often than it loses and has small drawdowns, with a hard stop loss on every trade, is a reasonable tool for an experienced trader. It also makes sense for hedging. If you hold a long-term spot position and you want to protect against a short-term drop, you can open a small short with leverage and effectively insure your position without selling the underlying. This is what leverage was originally for, before it became a retail casino. It can make sense for arbitrage, where you are trying to capture small price differences between markets and you need size to make the tiny spread worthwhile. But arbitrage is a professional game, and the spreads that are easy to find are usually not the ones worth taking. None of these use cases involve 10 times leverage on a hunch. The pattern across all of them is low leverage, clear thesis, short horizon, hard exit. The rule I want you to leave with, if you take one thing from this lesson, take this. The purpose of leverage is not to make more money. The purpose is to use capital more efficiently when you have a verifiable edge and the discipline to manage risk. If either of those is missing, and for most beginners both are, leverage is just a faster way to lose what you have. Start with no leverage. Trade spot until you have a strategy that survives a backtest, a paper trading run, and several months of small capital live trading. Then, if you choose to use leverage, go to 2 times. Stay there for a long time. Never go above 3 unless you have a written, tested reason that has nothing to do with wanting bigger numbers. Calculate your liquidation price before every trade. Set a stop loss above it. Know your daily interest cost. Don't add to losers. Don't hold losing leveraged positions overnight hoping they recover. Treat leverage like power tools. Useful in skilled hands, catastrophic when used carelessly, and absolutely not something to pick up the first day you walk into the workshop. That is the lesson. The mechanics are simple. The math is unforgiving. The discipline is everything.